We've been looking at the 10-year note yield as a great way to understand opportunities as well as risk in the market. Let's expand on that a little bit, but let's spend some time on the charts today. We're going to be looking at initially the SPX. This is the index for the S&P 500. So it's a great proxy for what's going on in equities. And as most of us know, since about July of '07, the equity market has been having some struggles all the way through to about the end of the year, and then subsequently it's entered into a bear market. But this volatility really commenced here with the price shocks that occurred in July of '07. So you can see that right here. Subsequent price shocks, and then as oil prices began to compound the problems here, we can see a lot of volatility in the market and ultimately a big decline. And what this reflects is the fact that traders are beginning to discount the market for two reasons. Number one, they expect that the risk of low performance in corporate America or in stocks is likely to decline in the future. So, or rather, the risk is on the rise, that there is going to be low performance in the future. So they're discounting those stock prices even before that performance began to play out, which it subsequently did. So it has extended this downside rally. Well, as traders begin to see risk in the market, you'll see a flow of capital from riskier assets, which the equities would clearly qualify, to less risky assets, and that would include bond yields or note yields. And in this case, we're going to look at the 10-year note yield index, which is actually very convenient and extremely available. So let's take a look at that now. The symbol for the 10-year yield index is something that you can find it on just about any free charting package. It's very available and it's pretty handy. The symbol is TNX, and it's usually some version of that depending on the charting application that you're using. Well, we can see here the same thing was going on. So yields mirrored equities during this period. So from the about June was when we saw yields start to crack a little bit, and then of course July when it accelerated, as what was happening was that investors were moving from riskier assets such as equities, and they were moving into safer assets, and in this case the 10-year note. Well, what happens is the yield, so which is the chart of the yield is what we're looking at right now. The yield is comprised of two things. It's comprised of the discount on the note. So if you remember from our last segment here, we were talking about that although the bond may have a par value of $100, so you may get $100 back at the end of maturity, it's probably selling for something less than that as they make up the difference. So there are two components to a bond's yield. There's the bond discount, so that what is it less than $100, and it is possible to cost more than $100, by the way, but they adjust the price to kind of make up the difference, as well as what's the interest payment on that particular note. So you put those two things together and you get its yield. Well, what happens is when equities drop, yields also drop because that discount on the note or the bond itself shrinks, because demand is going up. So yields are actually inverse to bond prices. If we overlaid a chart of the 10-year note itself, so how much does the note itself cost, it would be exactly inverse of the TNX. So it would be going up during this period where these are going down as investors moved into that asset. So now it's convenient because it doesn't move contrary to the equity market, so we can kind of get an idea as to, well, bond yields are going to drop when the equity market drops, and bond yields are probably going to rise as the equity market rises and becomes much more attractive. This is the relationship that we're looking at. When risk goes up, equities go down, yields also go down. You'll notice that over the last few months we've had a little bit of a recovery in bond yields since March through about currently. We've had a little bit of a correction here, but from about March through July we've had a little bit of correction in yields. What would that mean has been happening in higher risk assets like equities? Which direction would they have been going during this period? Now, typically you would say, well, they've been going up, and they did start out that way. So from here until then, they've at least stayed stable since March through July. And there was an uptrend here until about May when things really started to decline on equities. And we can take a look and see, well, how did this play out in the TNX itself? How did this play out in bond yields? Well, we certainly saw a slowing during that period. So bond yields did not keep rising during that same period that equities were correcting, and we did get a pretty good correction there in June and July. One of the things that we would assume here is that the correction on equities may be actually a little bit too deep. So they're beginning to disagree with each other a little bit. One of these is probably either overbought or oversold. So there's beginning to be this little intermarket tension here. But for the most part, they're going to mirror each other as capital flows from one asset class to the other. Now, this imperfection between the way that they move is a good thing. It doesn't mean that they're moving improperly. In fact, as a technician and from a technical point of view, as we're looking at intermarket analysis, these differences, so when the markets begin to diverge from each other, these are very important signals. We looked at this when we looked at commodity prices versus things like the Aussie or the Kiwi dollar. You can see this same relationship as investors move from risky assets to less risky assets and back and forth again on the TNX as we look at the longer term view. So starting from the middle of 2003 until about 2006, we had a bull market in bond yields. Well, and prior to that, we'd had a significant decline or correction in bond yields. Well, we can look and find the exact same thing in equities themselves as traders in this case moved into safer assets, which pushes yields down, and moved out of safer assets and into riskier assets, which pushes yields up. Well, as you can see here in equities, we've got the same thing going on with the correction in 2002 and the bull market from the middle of 2003 through 2006. So the same things that we were looking at here. Now, the differences between the markets, and so far we've been looking at making this risk analogy, so as from safer assets to more risky assets and back and forth as capital flows between the two types of investments, we've been looking at bonds versus equities. Well, how does this relate to Forex traders? Well, it's all wrapped up in this whole idea behind what's going on in the risk environment, because we can take this information beyond equities and into the Forex to start to time trades and look for opportunities. Now, in the write-up, I mentioned two currencies that respond pretty well to this relationship currently, and it's always shifting a little bit in the market, but we're going to be looking at these two types of currencies as we evaluate how would we use this to time entries and to find opportunities, as well as to manage risk in existing positions in the next segment.